Welcome back. This is Messari's Unqualified Opinions. I'm Ryan Selkis, your host at 2-Bit Idiot, and this is sponsored by Token Tax and Token Soft. Today I'm with a buddy of mine that I've known basically since you first got into the industry, I think, and me, if we're being honest. Andy Bromberg from CoinList, co-founder and president of CoinList. We're going to talk about CoinList, digital securities. We're going to talk about token team compliance and ICO compliance in the US and a variety of other things. But I kind of feel like we should start with the creation story because it's interesting how many people from that organizational phone call are still in the industry and have been relatively high profile with the College Crypto Network. So we met back in, what was it, 2014, maybe late 2013? Yeah. It was early. But you started at basically running the Stanford Bitcoin or crypto club, and now we're here. And I've done many other random things. But for starters, why don't we talk a little bit about your backstory and evolution in the industry before we get into CoinList?
Yeah, sure thing. So I started in the industry loosely, at least back in 2012 and 2013, and was one of the folks that started the Stanford Bitcoin group back in those days. Which was led by Balaji Srinivasan, now the CTO of Coinbase. But at that point, a Stanford professor who was teaching us and convinced a group of us that Bitcoin was going to be meaningful and we should pay attention to it. So a group of us, 7 of us students, and Balaji and Vijay Pandey, who's now a professor and an investor at Andreessen Horowitz, started the Stanford Bitcoin group and began to do some research and build some cool projects and do some advocacy work. And at some point, very early on in our life cycle, connected with the MIT Bitcoin Club, or whatever it was. That what it was called?
College Crypto Network, I think.
Right, through the college.
Whatever the first. Now it's the Blockchain Education Network.
That's right.
College Crypto Network. It was, I think, on that first call, it was you, me. I don't know why I was on, by the way, because I had skipped on MIT's Sloan. I had deferred my offer, but right. I knew Dan Elitzer, who's now at IDEO and their fund. And Jeremy Gardner, who now has, he was one of the co-founders of Augur and now
Awesome Ventures.
Awesome Ventures. Yeah. It was just a motley crew on that first phone call. And I was sitting here as the only non-student saying, I don't know why I was invited to this, but it's nice to meet you guys.
A lot of fun, yeah. One of the earliest connections,
And then that all obviously, sprung up pretty quickly into a number of different universities. But you're in Stanford, so you get to meet Balaji. That's about as great a connection as you can have to everybody in the industry, especially starting out. When did you start working with Naval?
Yeah, so I ended up leaving school and started a company not at all in the crypto space called Sidewire in the political media space and ran that for a few years. And then as that was wrapping up, this was mid-2017, CoinList was getting started. And the story with CoinList is that it was originally a collaboration between AngelList, which Naval founded, and Protocol Labs, who builds Filecoin, among other things. And they were working together to build this platform for the Filecoin token sale because there needed to be a place where people could go through compliance and make investments and receive their Filecoin SAFTs and eventually tokens. And so they created this thing called CoinList. And then at some point in the process realized it was a lot of work. Every token issuer is going to need the exact same set of services, so that should be a new company. And so with the rest of the founding team at CoinList, I kind of came in there as one of the founders to get this new independent company, CoinList, started out of that collaboration between AngelList and Protocol Labs. And I got involved there because I knew a lot of the AngelList folks just from being in the Valley and dealing with different people. I knew the Protocol Labs team. And so it was natural to come over and start working on that collaboration.
Was that the first SAFT?
It was not the first SAFT. It was the first really big, publicly known SAFT.
Because I remember the SAFT paper was authored by
that's right,
Marco Santori, who was the representative for Protocol Labs at that point, and Juan.
Yeah.
And they presented it at Consensus. And then a few months later was this initial sale. But I didn't know if anyone had actually used that documentation after it was presented.
Yeah, there are a few architects of the SAFT. Polychain Capital was doing a lot of work with that general concept. Cooley, obviously, where Marco was doing a lot of work there. Protocol Labs contributed a ton. And they ended up launching, the SAFT project website and idea that formalized it a little bit further. But the idea of selling pre-functional tokens in a network as a security had been kicking around for a few months before that.
So whether they were first or large, certainly the most high profile.
Yeah, that's right.
And talk a little bit about that process, because from, I'd known Juan and the Protocol Labs guys, again, for years, both individually and then as an investor at DCG. And my general sense was they tried to make it as inclusive as possible, but it wasn't the perfect rollout as any first iteration is. So talk a little bit about the sale, some of the design goals with CoinList and how it was actually going to facilitate these transactions, and then that auction that took place during the public component of this.
Yeah, I think the number one priority for Protocol Labs, which I actually think sounds obvious now, but was very forward thinking in mid 2017, was compliance above all. How can we make sure that what we're doing here is not going to cause issues for us in a year or 2 years or 5 years or 10 years? And so that was a lot of what we kind of built CoinList to do early on, was support that. Now, obviously, a lot of teams are saying that, but in 2017, it felt much more like a cash grab for a lot of these token sales. Get as much money as possible. We'll figure out the consequences later. Don't worry about it. And Protocol Labs went and said, we're really going to care about this because we're trying to build a generational company here. And there's not a lot of things that could really kick us off that track. But one thing is compliance issues and legal issues.
Yep.
So a lot of the work there was around who is allowed to invest in this offering, how can you diligence whether or not those folks are actually allowed to invest in the offering, that they are who they say they are, that they're accredited, whatever the criteria might be. And that's a lot of what that core CoinList platform was built to do. And then once you get past all of that work, the make sure this thing is legal work, the next step is how do we ensure the best outcome here for everyone involved? And that's not just measured, although certainly Filecoin scores highly on this metric, not just measured in terms of dollars raised, right? But also inclusivity of the network sale. So one of their big goals was we want as many people as possible to be stakeholders on this network from day one. So how can we do that? And so the way they ended up structuring it was as this auction, effectively, which serves as a price discovery mechanism, where they went and said, most likely everyone that wants to invest in this token sale and is qualified to do so legally will have a chance to, which ended up being accurate in the way that their sale ran. And there'll be a price discovery process to figure out what the market will support for this asset during the sale. But they did something really smart, and there were some technical hiccups along the way, but they did something really smart, which was when you do an auction, there's a lot of different factors to balance. And one of them is that you don't want the fastest people to click on the page to be the ones that get the best price for only the reason that they were the fastest to click on the page. And that just doesn't really make sense. It doesn't make it fair. And they were aiming for the most fair and equitable distribution of tokens possible. And so what they ended up doing was, over a chunk of the first period of the sale, a certain number of hours, all of the investors got averaged in at the same price. So if you kept investing after that initial period, if you didn't make an investment at the beginning, then yes, you had a higher price to pay. The market kind of found its total price that it could support. But at the beginning, it didn't matter whether you clicked fast or even if you were an hour late to the sale or a few hours late. Everyone got averaged in during that period at the exact same price. So it rewarded early contributors in a way which shows support of the network, but it did not do so in a way that was kind of perverse and relative to just people's clicking ability. It was, did you commit early enough? If so, you get a better price. And last of all, and I think this is something that Messari is doing amazing work on, they were transparent about all of that. And they published the economic model of the sale in advance. They told people how it was going to work. They were really communicative about that whole process, which is something that we still encourage our clients to do, is that you have to be open about these things. No one knows today what the absolute best way to run a sale is from any number of perspectives. But if you do your absolute best and then you communicate that really clearly to everyone that might be involved in the sale, that's the most important thing that you can do.
Yeah, and so I mean, full disclosure, I was an investor in the advisor sale, and happy supporter of them and the team. And I actually wrote, I think, a few thousand words on why I thought it was like the first ethical token sale that I'd seen, and one of the reasons I wanted to participate, just almost on pure principle, because they locked up investors with vesting schedules. They had this very clearly laid out, and hypothetically, these were all savvy investors because they're accredited. So you shouldn't have the same concerns if you were doing a token sale direct to retail, where you're potentially dumping on unsuspecting investors that are not really paying attention or dotting the I's, crossing the T's. So there was this time element that locked people up. There was the savvy of the investors, and then I think there was a chunk of it that was it looked more credible because the platform had been built from both Protocol Labs, but then AngelList, which has done this accreditation in the past, and that joint venture was very interesting. So that's that disclaimer out of the way. I think I'll define Protocol Labs because we kind of skipped over that. I think many people might know, but some might know it as Filecoin. Some people might know IPFS, but they might not know the interrelation. So Protocol Labs is the company that created IPFS, which is a decentralized storage network that many of the protocol teams have used historically to save data and files in a decentralized way. Filecoin was supposed to be the scarce digital asset that could secure that decentralized storage network, and it was released after many people had used IPFS. So I bring that up both to be a little bit clearer because we just threw around like a few different entity names and one and whatever. But I also think it's important because what you saw with the Filecoin sale is people buying into a resource that they believed was securing an already existing network that was in the wild. So even if Filecoin itself was delivered as a security via the SAFT offering, because that network and that mechanism to secure IPFS was not yet built, some of the underlying pieces had already been built and were live for a while.
And actually, on that, by the way, I remember I saw Juan give a talk about IPFS, the Interplanetary File System is what that stands for, which is a great name, back in, I think it must have been 2014.
Yes.
He'd been working on IPFS for a long time. Before this concept of tokens as these network security functions outside of really just Bitcoin existed. And so that was another thing for that sale that gave a lot of people a lot of confidence, was that this technology had been in the wild for years and been developed for years without any sort of direct profit motive behind it for a long time. He was building this technology, trying to make it work. And then as this idea of a token, a protocol token, came up, it happened to apply really neatly to this technology that he and the team had already built at Protocol Labs. And that's something else that gave people a lot of confidence in the project. There was years of development work behind it, and it was just a really good fit for this token model.
I want to, we're probably towing the line a little bit. I want to step back from coming across as if we're just shilling a specific project. But the reason I gave that background, A, the disclosure, but B, the project background, I feel like the other teams that you guys have taken on for token sales have all fit a similar definition, at least that I can tell, where some core components of the product have been built. There's both social and technical proof in the validity of these systems, and this is one of the final pieces to the puzzle that you guys are helping with. So what is your methodology for actually accepting projects onto the CoinList platform, given how unclear the regulatory regime, especially in the US, is, and you're a Silicon Valley-based company?
Yeah, no, it's an important question. So when we look at a project, and I should emphasize, we don't offer investment advice. I'm not doing that right now. And all of these projects are incredibly early stage, the whole industry is, let alone individual projects, and are incredibly risky investments to invest in. So we just do our best to work with good customers on the token project side. There are some things that I think every investor should look at when they're considering a token sale, and there's some of the same things that we think about generally when we're thinking about who's a good customer for us. There's basic criteria that you evaluate if you're evaluating any startup, let alone a token startup. So is it a strong team? Does the product make sense? Is it a good product? Are they attacking a big market? Does the market, can it support what they're going after? And do the deal terms make sense? Are these valuations, where do they land relative to the market? So those are pretty standard evaluation functions for any type of early stage investment. Beyond that, there's really two things we look at, and the latter touches on what you mentioned. The first is the token economic model. And that means a lot of things. We could spend hours unpacking that term. But at its core for us, two things that I think about are, one, will this token, if the product is successful, if the network is successful, will the token accrue value in the long term, which would make it a good investment? And two, are the incentives aligned on this network with this token? Are the good actors, the necessary parties, appropriately incentivized to behave well on the network? And then, on the flip side, are potential bad actors appropriately disincentivized from attacking the network? So when we think about token economics, that's what that sums up to. Both, will it accrue value if successful? And then two, are the incentives aligned properly? And then the last piece is the legal and regulatory structure. If you're evaluating a seed stage investment, equity investment in a company, they're not doing anything innovative with their legal structuring, most likely. It's a pretty vanilla process at this point. To your point, the regulatory environment, but also just the legal standards in this space are relatively immature. And so you really have to think about how they're structuring things and if it makes sense. What we've gotten comfortable with is this idea that all of the token issuances, token sales that have used the CoinList platform publicly have been conducted as offerings of securities. And that's what we can get comfortable with. That's kind of our most conservative, safest stance. That does not mean that those tokens will always be securities. Some of them, like Filecoin, intend to become non-securities at some point in the future, but they're offering it, or offering a document as a security upfront in the offering. Some of them may stay securities forever, but some of them may try and transition out.
Will you be part of that transition, by the way? Right. So I executed the Filecoin documents, and I have the SAFT. At some point in the next year or so, those will start to be delivered. Is your role complete? Is this on the Protocol Labs team now to manage that transition, or are you still part of that process?
Yeah, so every customer is a case-by-case situation for any given service that we offer, but one of the things we do help with is distributions of tokens. So for some of the projects that have worked with CoinList that have already distributed their tokens, unlike Filecoin, which is not yet.
It's only like a half dozen, right?
Yeah.
So far?
Yeah.
So it's Filecoin complete, Blockstack complete.
Yeah, Props, Origin,
you know.
Trust Token, and then Ocean most recently. And those are the public ones. We've also privately worked with dozens and dozens of issuers, but publicly those are the ones that have been on the website.
And this is an important nuance that I know you say intentionally at first listen people might not recognize, but you are very consciously saying issuers.
Yes.
Because we're separating the token sale or the token generation events, which is legal jargon for, oops, maybe this wasn't a compliant offering,
right,
and the actual offering and issuance of a bona fide security in the form of the SAFT instrument.
That's right, yeah. So all of these projects, again, that have worked with us, issued securities and used the CoinList technology platform to facilitate parts of that transaction process. And so we use the word issuers because that is what they're doing. And in the rest of the world, the non-token world, that's the most common word that you use when you talk about someone that is selling a security in some way. So important for us just to reinforce that terminology with people. And I think it helps even talking to regulators and folks in government when you can be clear that you're actually doing things the right way from the beginning.
Do we still call them SAFs, or are they now deferred distribution agreements?
Some people call them SAFs, some people call them different things. I think what's interesting, though, is that to that question, and what Ryan's getting at is, we've now seen a lot of documents that look very similar but have different names at the top of them. The concept that was behind the SAFT has lasted. This is now a year and a half, almost 2 years old, and it's this idea that for a network whose tokens have not launched yet, you can sell a piece of paper as a security that gives the people a right at some point to get tokens in the future. And a SAFT is a simple agreement for future tokens modeled after the Y Combinator SAFE, simple agreement for future equity. There's deferred distribution agreements. There's a million different words that you can use to describe it. But at the end of the day, this idea that I can sell you a piece of paper that will, it'll be a securities offering, regulated, registered, or exempted securities offering, and then at some point you'll get tokens out the other end, has lasted for a year and a half or 2 years, which really points towards how thoughtful they were in structuring those early deals.
As you think about the market going forward, you're structured now to do securities tokens. We haven't seen them. You can argue that SAFTs or their ilk are securities, which they are, but those aren't securities tokens. Have you seen anything worth investing in on the security token side, or are you very happy to just have the Templums, the T0s of the world, some of the other Securitize, some of the other security token specific vendors take that on because you fit in this middle market right now where a lot of people are going to need help.
Yes, this is a really interesting discussion. I'm glad you called this out. The terminology has been very inconsistent across the industry.
You don't say.
I've had people, I know. We've certainly had people at CoinList come to us and say, you guys haven't done any securities token offerings. When are you going to start doing securities token offerings? And we've had people come to us and say, CoinList has only done securities tokens. When are you going to do a non-securities token offering? Those are clearly inconsistent. So there's something wrong here with the terminology. And I just want to emphasize the way that you said it there, which I think is really important. My view, I see it the same way. A securities token is a token that will always be a security. It is by definition a security. It's not changing. The most common example of these that you hear about are these asset-backed tokens, so equity-backed tokens, real estate-backed tokens that are intended to always be securities. What I view that we've done so far at CoinList, the customers we've worked with, what they've done is they have sold securities that represent tokens in the future, which are not necessarily securities tokens. It's a securities transaction representing what is potentially a non-securities token. I know that's a mouthful, but I think an important distinction to draw. My thesis on this, and just a personal view here, is that asset-backed tokens, so tokens again backed by equity or backed by real estate or something like that, are a little ways off. I do not see today the investor demand for securities tokens, for asset-backed tokens in a meaningful way.
I would agree with that.
What I do think is interesting is that there's an in-between state that I think has not been fully explored, but people are starting to hit on, which are non-asset-backed securities tokens. And so a couple examples of this, then I'll explain what I mean by that. One that's still going and going strong is a company called BlocksRoute, which is really interesting. We can talk about them. Another one, probably the one in this category that most people know.
Simon Gunsire.
Yep,
right?
exactly. Yep.
Cornell professor.
The one that most people know that falls in this category, unfortunately, is Basis and their shares token in the Basis ecosystem. Not the stable coin, but the shares token. Basis now has wound down operations, unfortunately, but it is the most well-known in this category. I like to call these profit tokens. So they're tokens where it is a security and will always be a security. But rather than being backed by some real-world asset, some physical world asset, like equity or real estate, it's backed by the value of the token network in some way. And so what's interesting about these types of tokens for me, these profit tokens, as I call them, but certainly open to better names, is that they're securities. So they force securities token infrastructure to be built. You have to build exchanges and issuance platforms and compliance solutions to support them because they're different from at least these intended to be non-securities tokens that have previously come out. But what's interesting about them is that their risk reward profile looks a lot more like a protocol token or a network token than it does like an equity token or a real estate token.
So we've just, in terms of like taxonomy rules, broken all of them.
All of them.
Because you just said 7 different things.
I know, yeah.
When you say profit tokens, are you thinking, some people call them work tokens, right? So Augur's rep, you would stake in order to earn network fees.
So I don't.
Are these distinct?
They're distinct, and
as you define
the
them?
reason they're distinct is when I say profit tokens, I'm talking about tokens that are intended to always be securities, and Augur is not intended to be a security, right?
Yep.
So I put Augur in the protocol or network token bucket, which is what a lot of these token sales and ICOs over the past couple of years have been, is these tokens that are intended to be non-securities, but earn value, accrue value based on the activity on the network that is happening, right? Work tokens, staking tokens, all fall into this category. I'm proposing profit tokens as maybe a step beyond that, where they similarly earn value from activity on the network. They scale with the network value, but they are intended to be securities through and through, no matter what. And what's interesting is the reason those two sound so similar is that they both earn value from network activity, right? Which means that an investor who would invest in one is likely to want to invest in a different one. And we saw that with Basis. Basis went and raised over $100 million from a lot of the same investors that have been investing in protocol tokens, network tokens from the beginning. And so it's a similar type of investor. And so this in-between profit token state, if done well, which I hope it is, could be kind of a bridge where without needing to go and find new investors for the space. The same investors are interested in them, but it will force the space to build out the security token infrastructure. And once that security token infrastructure is built,
5 years from now, it's a different story.
Then it's a different story about attracting investor interest in real estate or equity-backed tokens.
I'm not sure if everybody is completely lost at this point.
I know,
because you and I are aliens, and we've been in the weeds, and we've done all this jargon, and we can kind of ad-lib this. So for those that don't have this rap genius living in their brain for nerdy crypto stuff, how does someone coming to CoinList actually learn what they're getting into, right? Both historical assets that have been listed and the current offering. You're going to have the basic documentation, but is there any broader library or standardization that you guys are working on with respect to the materials that are available to the folks that are parsing these?
Yeah, so we work with the issuers that use our platform to create these deal pages, usually content by them that describes their project in depth. And there's a lot of commonalities across those, but it is not, at least not yet, standardized in a kind of absolutely consistent way. And I think part of the point there is that a little bit intentional. There are some pieces that every token project should talk about, that people should be informed about when they're investing in a project like that. And again, that's things like, who is the team? What are their backgrounds? What are the investment terms? What have you done so far? What are the proof points? But then there are some things that make sense to talk about for some projects and not others. And so we do want to make sure we give that flexibility to the token issuers to write about what they think is relevant. And obviously things that everyone legally is comfortable with having on those pages. But we try and have pretty thorough pages on our platform that really describe what's happening, and then lots of documentation to back it up from the issuers about what the token sale terms are and what they're doing and how they plan to proceed.
Yeah, it's interesting, and I think the materials that have traditionally been on CoinList have been pretty polished. Certainly by industry standards. That's a ridiculously low bar, but I'll give you guys a little bit of credit. And we were actually very intentional when we thought about our own disclosure forms to start with extremely remedial disclosures, just so we didn't have this wild inconsistency with the quality of everything else, right? If you ask a CoinList project for the equivalent of like a business description and risk factors, you're going to get something like IPO quality, right? In the equities realm, or at least a step much closer to it than what you would get from someone just hanging a shingle trying to do a crowd sale with very limited oversight. So I think that intersection, we start with the bare bones and can work our way up. You guys and others that are trying to professionalize this, I think, try to set the standard for what could one of these token offerings look like, which I think we'll meet in the middle at some point, but the industry is still quite a ways away from that.
And one thing that we're starting to see from token projects that use the CoinList platform that moves towards meeting in the middle is open Q&A webinars. Recently we've done webinars where investors or advisors in the projects interview them, and these projects host these webinars and can have the world exposed to some real back and forth with them between people that are familiar with the project, and then open Q&A, being able to answer questions. I do think that transparency piece is so important for these projects, and especially going forward, early days of token sales, and again, this is something I think some of our early customers did a great job of. It was not really necessary to be incredibly transparent in the early days.
Oh yeah, it was just
money was flying around.
Exactly.
But they went and did it anyway, and they said, we're hosting webinars, we're being open about this stuff, and now I think increasingly, which is great for the industry, the incentives are aligning, and now it's much harder to raise money if you're not transparent. And so you really need to be good and transparent, not just out there with good marketing at this point.
How do you think about the limit of what's mandatory as a disclosure? Because it strikes me that with private deals, there's always going to be bespoke negotiations, and there's going to be other agreements that are struck with maybe the token creating entity versus the token. What level of detail do you think should be applied when you know that many people that come in through the CoinList offering, they're going to have different terms than the Andreessens of the world and the Polychains of the world that actually got them to this point, and frankly, I believe are a large reason that they're even in the running to be listed on CoinList, because you guys like to see some social proof. from what you call legitimate investors,
Sure.
or high-profile investors that have actually made a bet. It's important to note that there's a massive difference between the terms that they get and whoever's coming in next. What level is appropriate to disclose? And how can you guys start to push the envelope there?
Yeah, I think there's really two levels of disclosures for token issuers that they need to think about. One is just legal requirements. And when they're selling securities, there are a whole bunch of requirements about what you need to disclose, how you need to frame it. Securities law ultimately is all about disclosures and being open about things. And so working with great counsel and we have opinions on this too, obviously, there's a bunch of things they have to disclose in a purchase memorandum or the term sheet for the deal or anything like that. So that's the baseline. That's what you have to do, otherwise you're not being compliant. And so there's that. The second side is, what is your duty to inform investors about, right? And I think this is maybe the more interesting question here. What should you actually be saying to people? And I think there's a lot of information. Again, it's specific to every issuer, because at some level, I think the most important things to tell investors are the things that they would not otherwise assume, right? So you can go out and you can make all sorts of disclosures about things that are plainly obvious about your project, and you should do so, but that doesn't really add a lot of value to the investors. What you should be doing is going out and disclosing what is not obvious about the project, and making sure investors are aware of the total facts and circumstances surrounding the offering before you do that. So yeah, I do think things like, what are the previous terms? What does the distribution of tokens look like so far? Who owns what, and how's that going to change going forward? How is inflation going to affect the network? If you buy this much now in 2050, what will that look like? And so all of those questions, again, some may apply more than others for different networks, but it's about what's unusual about your project that investors would not assume or wouldn't be able to easily kind of intuit from just basically reading about your project. And I think one really interesting one on that, just to give a specific example, is inflation schedules and kind of network growth schedules. In some cases, it's really simple, and you can write one sentence and say, Grin is going to grow at 1% every year, and that's the way it is, and that's all you need to say, because that's the sum of it. Now, it'd also be nice to maybe put some graphs and models and help people understand what that means for them practically, but you fully disclosed it. Some networks have way more confusing inflation schedules, or potentially can even modify it at their own will later. And those sorts of things are really important, because those impact what the investor is actually investing in and what their stake is going to be at some point in the future. So all of that is really important to disclose.
I asked about the post-sale support that you guys will offer. What we didn't touch on is whether you will help with listing. And this is a multi-million-dollar, sometimes billion-dollar question for some of these projects and their assets. How do you go from private sale or ICO to a liquid market on a Binance, on a Coinbase Pro, etc.? And traditionally, an entity like CoinList would be serving as the investment bank that's actually facilitating that process and those conversations. It's not clear in this industry that the same is necessarily true. Will you guys touch those conversations? Is there a dividing line? If not you, is it back on the projects, or is there another type of service provider that's going to have to step in the middle?
We're actively evaluating exactly what our role should be in that right now. I think it's important to note that there is a big difference between traditional equities and crypto when you talk about listing, which is in traditional equities, and I'm oversimplifying a little bit here, but generally you see the ticker for a company on a single exchange. Something is NASDAQ listed, or New York Stock Exchange listed, or listed on a commodities exchange, but it's on one place. Now, of course, behind the scenes, they're trading between all these exchanges, but the listing happens in a single trading venue. And that's not true in crypto.
I would argue that it probably will be, though. So whether it's a central exchange or a decentralized order book with kind of pooled global liquidity, I have to imagine that's where we're ultimately going to go. The question is, just like NASDAQ gets some listings and NYSE gets others, and then the international exchange, the same thing, it doesn't make sense to me that Binance would win one asset, it doesn't make sense that you'd have Binance and Coinbase Pro list the same asset. It does make sense that you'd have one win a CoinList project versus the other, which would win a I don't know, Templum project. You know what I mean, right? So I'm trying to understand how you think about the next 5 years.
Right. I'm willing to believe that, certainly. I don't have as much conviction on that point. I think it's possible that this exchange landscape stays fragmented for a very long time, and particularly over the next 5 years. I think it's unlikely that we will see a lot of projects move to single exchange listing models. And I think a lot of the order book pooling, which is a big concept there, the kind of especially decentralized order book pooling, I don't think is going to be totally unified on a short to midterm time scale. I think it's
right now it's going to be the prime brokers that are aggregating, and wouldn't you know it, all of our centralized exchanges are actually forming a decentralized asset.
Yes, exactly. What a coincidence.
Or a decentralized order book,
right.
Because liquidity is so fragmented.
That's right.
Really interesting how you think about what's next. What do you think people are not aware of right now, given where we are in the market cycle regarding token sales? Because I think in the U.S. there's kind of like an ICOs are dead mentality and vibe. There's a ton of private placement activity. You guys sit exactly in the middle, and Ocean, I believe, was the first that you've done in
a while,
9 months, 12 months almost, right? So is that an outlier, or like what should we expect for 2019, 2020 in the US in particular, knowing that Binance has its launch pad and you're going to be able to do things in Hong Kong and Singapore and other jurisdictions that you can't do in the US, but within the US, what will that look like in the next couple of years?
It's a really, really interesting one. I think a bunch of answers to that. One is, I do think the token sale landscape is changing, and we're going to see it look more and more like what traditional early stage venture capital looks like, where rather than a single private sale and then a big public token sale, or one private sale and nothing else, we're going to see kind of a sequence of private raises as the issuer makes progress, and then at some point an event where they sell it out to the public for some definition of public. But I think that public sale will be less and less focused on dollars raised and more about people reached, and the dollars raised will happen in the earlier private sales. It'll be more about access and less about dollars. So I do think that's changing in the token sale landscape. What I'll say in terms of,
I think that's a very rosy outlook, but I'll let it go.
I think over the long term, we'll see that kind of movement happen towards sequenced private raises. I think in terms of the environment and where we are in the cycle, I remember back in 2013, crypto had a huge run up. Bitcoin really at that point had a huge run up, and then it crashed. And in 2014, for basically the whole year, I don't know how you felt, but I felt like everyone was moping around and upset and just not happy with crypto. And then in 2015, the price still hadn't gone back up. In fact, it was right around where it was in 2014 for most of the year.
The bleeding just stopped.
The bleeding stopped, and it started to feel really positive. And 2015 felt generative and exciting, and people were building things. Then in 2016, we started to see the prices run back up again. I feel like this time, the 2014 mopey cycle was way shorter. Like, I felt like that was for kind of the back half of last year, maybe into January. I am incredibly excited today about everything that's happening. I feel like a new little project, even if it's just a side thing, I feel like I hear about something new every day that's exciting and interesting.
The pace is insane.
The pace is insane, and price hasn't really moved that much. We broke 4,000 on Bitcoin, which is very exciting for a lot of people, but not where it was. And so my feeling is that the kind of 2014 equivalent bad period, upset period, was pretty compressed this cycle. That's not to say that the 2015-esque period is going to be compressed as well. I think it might last a while, but I don't think, whether or not prices move, exciting things are happening, people are really positive. What a lot of issuers told us at the end of last year, because a lot of people were planning sales in Q3, Q4 last year, they canceled them, they delayed them, and what they told us was, we're not going to do this right now. We're just going to wait for the market to stabilize. We don't need a crazy bull market again. We just want a little bit of stability, which makes sense. Right after a crash is a bad time to go and ask people for money. And so what?
And then that, by the way, that's not just true on the token side. That's true on the equity side too. We were certainly in that boat, and were able to string out a couple extra quarters before.
That's right. Yeah, and so what I feel, and that what they were telling us has turned out to be true. just speaking from what we can see internally at CoinList, our pipeline is crazy for this year. There's a ton of people conducting sales. And everyone is really coming back and saying, it wasn't that we needed a bull market, we just needed stability. It feels a little more stable now. The market feels positive. Are we going to see a bunch of $200 million token sales this year? I don't think so. But what we will see is a bunch more issuers going out and beginning to offer these assets to a larger audience and trying to raise money. And then I also think a lot of private placement activity behind the scenes as well.
So that might be a good place to kind of wrap up with a final question. You guys are talking about mostly the primary sales, the first or maybe second sales in some cases. What we haven't talked about is this wall of illiquid 2017 SAFTs that are going to have to hit the market at some point, and the market is stabilized. Do they start coming now? What type of disruption do you expect from just chaotic selling of people that want liquidity? And might have a mandate and fiduciary responsibility to get liquidity on some of these investments that they know if they can just get their money back, they're in good shape. Does all that get absorbed and take away from some of the other exciting primary placements, or do you kind of view those as two distinct markets right now?
I think they're distinct, related, but distinct markets. I do think there are, when these start to hit the market, these tokens finally get liquid. There are good and there are bad ways to do that for these issuers to kind of help get this secondary market going. Two factors that I would consider is, one, how they structured it back when they initially offered the SAFT. So you pointed out one thing, but Filecoin and a bunch of other projects is they put vesting on these SAFTs. And a lot of investors could get discounts. They took longer vesting periods. And so that obviously is an enormous help. If someone has $5 million of some asset that they bought, and they don't get it until 3 years later, and it's coming to them in stages over 3 years, that obviously will dramatically reduce any selling pressure, even if it is a fiduciary duty of theirs to go and execute those trades. They just can't do it all at once. And so that's one thing, how they structured it earlier. And then the second is what they do to actually get it liquid in the early days. What you see for a lot of assets out in the world that move from illiquid to liquid, or are just generally illiquid assets, is they don't just throw these assets up on a order book and say, everyone trade, let's try and find a price. They run more thoughtful process. So whether that's an auction process or kind of a staged liquidity process, I think we'll see a lot of issuers experimenting with these sorts of things. And it would just be unusual to see this stuff go crazy. You look at sometimes on, and without trying to name names here, on some of the big exchanges when they've put new assets on, and it's been surprising in some way to people, prices have swung violently.
Well, I'd say more recently that effect has been very muted, which makes me believe, to your point, at least for the token assets, I would be very conservative in my expectations for a comeback. If for no other reason, then there's just so much that has to be absorbed from the private placements.
No, that I agree with. I'm just
maybe not Bitcoin and Ether in that bucket as much, because institutions will probably flow to those first. But for everything else, there's billions and billions of dollars of this crap, and a lot of it's crap.
A lot of it's crap. I agree with that. I'm more thinking of when there have been forks in the past of Bitcoin or something, and they've gone up on exchanges, prices have swung wildly, and that's a function of just not being thoughtful about how you roll out new assets. And so I think exchanges and issuers alike will have to be thoughtful. But I also agree, there's a lot of bad stuff out there that's locked up illiquid right now, and it's going to get liquid at some point, and the markets need to deal with that appropriately. It may mean that investors lose money because they invested in bad projects. It may mean that exchanges don't list certain assets. We'll see what happens, but I'm cautiously optimistic about those projects that are really genuinely, obviously high quality, being able to have successful listing processes if structured thoughtfully, and beginning to get liquidity to these early investors who deserve it and have held tokens for a long time.
Andy, always a pleasure. Good luck with everything.
Thank you. Likewise.
One of the good guys trying to clean up some of the excesses from 2017 and do things the right way in the 2.0. Guys, if your brackets aren't busted, they probably will be shortly. Enjoy the tournaments, and we'll see you again next week. Peace.
Thank you.